Good afternoon. My name is Jenny Ching. I'm with KW Commercial, and welcome to our October commercial seminar. Today's topic is 1031 exchange, and our speaker is Phil Atwan. Phil has been with Exchange Resources from the beginning. He also speaks to more financial, real estate, and legal professionals about 1031 than probably anyone in the country. Phil is featured at approximately 150 educational seminars per year, hosted by financial planning organizations, escrow associations, CPA and EA tax groups, bar associations, and real estate companies in the greater LA area. His reach extends across the nation. Industry-related professionals and real estate investors from New York to Seattle to Southern California call him to learn about 1031 exchange and how to defer capital gain taxes. Phil enjoys assisting and educating people about 1031 exchanges. He also speaks regularly at the Board of Realtor continuing education functions and has long served in various Board of Director and official capacities for the escrow associations of the San Gabriel Valley. Phil began his career in 1982 in marketing and sales with a large title insurance company, transitioning to a 1031 exchange focus in 1998. He grew up in Pasadena and now lives in Whittier, where he and his wife enjoy their 3 children and 3 grandchildren. Without further ado, let's welcome Phil Atwan.
Thank you. Thank you. Jenny, thank you. Pauline, thank you. We have to rewrite that bio because actually there's 4 grandchildren with the 5th one on the way now. So
wow.
You know, we're very happy for that. So you have 3 doggies, I have 4 grandchildren right now. Well, thank you, everybody. I'm very honored and humbled to be with you today. Thank you for having me. I'm going to screen share and add in. What we're going to do is our advanced class today, especially since we're doing commercial. And the advanced class is going to deal with some of the areas that you need to be familiar with as it works with commercial and investment real estate. You know, the 1031 exchange rules pretty much work the same way for residential as it does for commercial. There's really not a lot of difference. But I would like to go into these areas that you just need to be very cognizant of, be aware of, because the bottom line is if you're involved with investors, you're going to come across this. Tomorrow night, by the way, I'm speaking at CARPA. We're going to be talking about the 1031 exchange and other tax issues, including the propositions. And I don't know if you know this, but right now, one of the presidential candidates has already said that he's going to eliminate the 1031 tax deferred exchange and also the stepped up basis. So obviously our whole industry is very concerned about that and the impact it should be not just for our industry, but for the millions of Americans who own investment property of some kind, whether it's a condo or a skyscraper in downtown LA. So the bottom line is we'll be talking about that more tomorrow, but today I want to talk about and just be positive that we will continue to have the 1031 exchange. We definitely have overcome objections and whether it's Congress or a president or whatever who's wanted to reject it, we've always seemed to have been able to win the hearts back of the politicians to let them know that this is really for the good of the country, and it is. And but let's get into some of the details now. So a lot of people ask me these questions. What would make a 1031 exchange qualified? For example, what if you have multiple people selling a property? I get this question nearly on a daily basis. What happens if I get a 2 or 3 or 4 or 5 people or more than that who want to sell the property? Can they go their own ways? I had this one guy call me. They had like 35 different investors involved in the sale of property. And the question is that they did not want to do exchange together. They wanted to go their separate ways. So the question is, can you do that? And what even is more difficult is if you have silent investors whose names are not on title and they want to cash out. How do you take care of that? Well, that we'll try to work with as we get a little bit down the road on this PowerPoint today. But for the next hour and a half, I want to concentrate on these issues and types of issues. First question you always have to ask when you go to take a listing on a piece of property is, who owns it? You know, and if you look at the green in the middle, is it an individual? Are they tenants in common? Is it an LLC? Is it a corporation? Could it be a trust? Maybe it's a limited partnership. And there are other ways as well, but these are the most common. So the big question is, when you sell, must the vesting stay the same? And can we all do a 1031 exchange and go separately, or only the ones who want to? And I'd like to spend a little time on this because this affects us all the time. Number one, if you are individuals, especially as tenants in common, or even joint tenants, and you want to split the ownership up, assuming that you're not married, what happens is you can go ahead and do your own thing and go your own way because you own as individuals, as tenants in common. So if there's three of us and one does not want to exchange and pay taxes, the other two want to either go together or go their own separate ways, they may based on the percentage of interest that they have, as long as they are a tenant in common. I could also have a trust as a tenant in common. So my wife and I can have our trust and own it with the other two. So our trust can sell it along with the entire property and do its own thing and do its own 1031 exchange. That is also allowable. But what happens if the property is owned by a partnership? What kind of a partnership? Well, a legal partnership like a LLC or a corporation or a limited partnership. Well, remember, like anything else in a 1031 exchange, you're not a name. Yeah, you have a name. And you file your tax return under your name. But that isn't what the IRS looks like. They want to know who's the taxpayer, or more specifically, what is the tax identification number that this tax return is filing. So when they look at my wife and mine, they look at our Social Security numbers. And that's what they're looking at. So if we're going to put in our Schedule E that we're going to be doing a 1031 tax deferred exchange, they want to know, will the tax ID numbers sell? And will the same tax ID numbers that sold also acquire the replacement property? Now, let's say it's in a trust. Sometimes we come across with some lenders who won't lend to a trust for whatever reason. So in that case, they say, well, you'll have to take the replacement property as a husband and wife as community property, as an example. Is that allowable? Could I change the vesting from my trust to husband and wife as community property when I go to buy the replacement property? The answer is the vestings are definitely not the same. But in our case, the tax identifications are the same. You see, because our trust bears our Social Security numbers as the selling entity. And if the lender will not allow us to take title to the new replacement property in our trust, but only in our names, well, guess what? It's the same Social Security number as the selling trust. So the government is okay with that because the same tax ID number that sold is the same tax ID number that acquired the replacement property. That's very important. And that's the way it works with all these others. For example, let's say if Jenny and myself, let's say she and her husband and myself and my wife buy a piece of property. Jenny, I assume you're married. So what happens is, let's say we have a piece of property and we have tenants in common and we sell it and we want to go our separate ways. We can. That's not a problem. But what if we own the property under an LLC? Well, if we have under or own it under an LLC, the LLC will have to produce its own tax identification number. That's very important because that tax ID number is what's going to file the tax return for that LLC. You see, it's not going to be my social security number. It's not going to be my wife's. It's not going to be Jenny's. It's not going to be her husband's. It's going to belong to that LLC. And remember, we don't own the property. The LLC owns the property. Why do we want an LLC to own the property? Well, because if something happens on the property and they want to sue, they can only sue the owner of the property, which is the LLC, which means they can take all the assets of the LLC, which happens to be that property. What does that mean? That means we are protected as individuals because we don't own the property. We're just what? Shareholders of the LLC. That's why we couldn't exchange separately, because we don't own the property. The LLC owns the property. So remember, if you have an LLC as on title, you got to ask the question, who are the shareholders of the LLC? Now, there's two kinds of LLCs. One's called a disregarded entity. The other one is a non-disregarded entity. So it's either disregarded or it's non-disregarded. What's the difference? Well, in a disregarded entity, you could only have either an individual or a husband and wife that own title in a community property state. California happens to be one of the few community property states. I forget how many there are now. That escapes me, but I don't think the majority are community property states. So what happens when you own a LLC in a community property state and it's owned by either an individual or a married couple, they can they can set up their LLC under the Social Security number. So the LLC will not file its own tax return. It's disregarded. That's why they call it a disregarded entity. It's disregarded to file a tax return. Why? Because it's just a pass-through entity to my wife and I, our tax return. Or if I did it as an individual, to my personal tax return. So the bottom line is that when you do, say Vince, if you could possibly mute yourself, that would be really good. Thank you. We're getting a lot of bad feedback from you. Thank you for doing that. I appreciate it. So the bottom line is that a disregarded entity says I still have the protection, the blanket of protection that people can't come after me or my wife, but only the asset. But I could pass through and not file its own tax return because it bears my Social Security number. Remember, not every married couple has a disregarded LLC. Not every individual who owns an LLC has a disregarded LLC. That means you have to find out, is the tax return being filed by the LLC on a separate return, or is it being filed under that individual name or that married couple in a community property state? So that's very, very important, because then you could actually change the title on the acquisition. For example, a lot of people they don't like to borrow when they go to buy a replacement property in a 1031 exchange via an LLC. Why? Because lenders are hard to find sometimes. Your typical, Chase and Bank of America and the rest of those large institutional lenders are not going to lend to an LLC for the most part. Some might, but for the most part, most of them do not. You're going to have to go to a mortgage company who lends to LLCs. All right, that's if it's a non-disregarded LLC. Or even if it's a disregarded LLC, they don't want to lend it to a LLC. So what I can do is I can buy under our Social Security number, but under our names. And then if the lender will allow me to, I'll put it back into the LLC after I acquire the property, just like I would a trust if the lender will allow it. So you'll need to do some checking and some research and some homework to make sure that when you buy the replacement property, that you can buy it under your name if it's a disregarded LLC, and see if the lender will allow you to put it back into the LLC. That would work. It would save you money on financing in terms of points and fees and interest rates, because the interest rates will cost you more in an LLC. So remember, I could blend a group of people under one LLC, but it will have its one tax ID number. So we can't split individually and go our separate ways because we don't own the property. The LLC does. But what happens in those situations where you do have multiple people in a non-disregarded LLC and they want to get out or they want to go their own separate ways? Are there ways to do this in a partnership? The answer is yes. The first way is called drop and swap. The second way is called swap and drop. And I'd like to take these individually and break those down for you. What is a drop and swap? If you say that in front of a sophisticated tax person who specializes in real estate, they'll know exactly what this means. Drop and swap means we don't want to be with each other anymore. So what happens is we can drop the title of the LLC. And we could all have title as individuals or married couples. We could have tenancy in common. My portion of the tenancy in common, I get set up an LLC that will hold title as a tenant in common with the others, or I can take it under my trust, or my wife and I can buy it as individuals. But once we drop the title, we can't sell. We have to hold that property in the new vesting with the new tax identification numbers for 24 months or 2 years, or so says the California Franchise Tax Board. The federal government does not require 2 years. In many cases, the federal government does not even, the IRS doesn't even require 1 year. You could blame this on the state of California and the Franchise Tax Board. And so the bottom line, even the State Board of Equalization for the state of California says this is too much time. But the Franchise Tax Board doesn't care what the State Board of the Equalization of California has said. So unfortunately, if you get audited, and you will, because they saw that tax ID numbers have changed, and you didn't hold it for 2 years before you sold it, then you've got a problem. So that's why you have to drop the title, hold title for the next 24 months, and then enter into a contract to sell. All right, that's very important. Before entering into any sales agreement, you have to have held for 2 years. That's drop the title, and then 2 years later, swap and do the 1031 exchange. But what if I don't have 2 years? Because I just took the listing and all of a sudden I got a great buyer, and the LLC has multiple members and they don't want to stay together. So what do you do then? That buyer is not going to wait for 2 years. And I've already entered into a contract. So really, I can't do it. So the government gives us a second option. And the second option is called swap and then drop. What it basically allows, if every member is willing to do a 1031 exchange, the LLC will sell the property. And then it will do a 1031 exchange and acquire multiple properties. One property, at least, for each LLC member. Yeah, and that value of that property will be in relationship to the value of their shares of the LLC. And then after the exchange is over, you cannot dissolve the partnership of the LLC for another 2 years or 24 months. The LLC will have to hold title to the property. Now, this is very important. If you'll see more drop and swaps, you'll see more drops and you'll see more swap and drops than you'll see drop and swaps because most people don't have 2 years to wait to sell the property. They would rather do the swap where they do the exchange first and then drop the title 2 years later and then get title to their own property. But you're going to have some kind of a legal agreement drawn up that the LLC will know how to divide the proceeds because it has multiple different properties. And one will say, well, that's my property, that should be my income, it generates more income, and on and on and on. So you're going to have to sit down with some kind of an attorney who's going to draw an agreement under a swap and drop to make sure who gets what after the 2 years have been served. That makes sense? This is a big deal. You'll need an attorney or at least a very sophisticated CPA to help you with this. They're very doable under a 1031 tax deferred exchange, but you just have to be careful when you have partnership interest. And if there's some kind of a partnership, especially in LLC, you can do this. You can't do this with a corporation, whether it's an S Corp or a C Corp. Why? Because once the S Corp or the C Corp dissolves, all the assets becomes taxable. So ultimately you're going to pay taxes. So on an S Corp or a C Corp, once it comes out of that corporation. So the swap and drop and the drop and swap will not work for an S Corp or a C Corp. It's principally for an LLC. Okay, I'm sure, I wonder there's going to be a few questions about this in the chat room afterwards, and we'll look forward to answering all your questions at the end of our time together here. Now, what else is qualified versus non-qualified in a 1031 exchange? Example, may I exchange funds into a property I just exchanged into and do improvements with the money? That's a good question. I get this question quite a bit during the week, several times. If I do a 1031 tax deferred exchange, could I hold back some of the money, not put it all into the purchase, and then later afterwards do the necessary repairs and improvements to the property with the money that came out of the sale? Does the IRS allow that? The answer is no, not under a typical 1031 exchange. You would have to do a different kind of 1031 exchange called a build to suit exchange if you'd like to incorporate the funds from the sale to not only acquire the property, but to do the capital improvements. I hope to talk about this a little later on this morning or this afternoon, and we will get to it. But generally speaking, if you hold back money from a sale to go into the property after you acquire it as a repair or improvement, that money that you hold back from the sale is taxable. Bottom line, you could only do a partial exchange. You won't get the full benefit of the 1031 exchange. Next, can I pay off a loan on a building or another property I own, such as another rental I have or my personal residence in a 1031 exchange? The answer is no. All the funds from the sale must go in, like we said on the last one, has to go into the acquisition, not to pay off debt on other properties. This is also not allowed. Next, can I do a 1031 exchange into a property I already own and build, like for example, an ADU in the backyard? Is that allowable? Because it's going to be for rent. I'm going to build an ADU behind my home or behind the other rental property that I own, so I can have like multiple units now. And the answer is no. You cannot do a 1031 exchange without acquiring real property. Remember, all you're going to do is to build on property you already own, whether it's a vacant lot up in Sacramento or whether it is an investment property that you own in Los Angeles or something in Alhambra, like your principal residence, you want to build something in the back. You cannot do that because you're not acquiring new property. You're not exchanging. You're just simply building on proper land, whether it's already improved or unimproved, that you already have. So that is not a 1031 exchange, and the government will not allow it. Next question I get, how about a leasehold interest? What if I have a mobile home on a lot. Could I do a 1031 exchange on the sale of that? My first question is, what are we selling? Are we selling land and a permanent fixed mobile home on that land? Or is it just sitting on the land, but you only have a leasehold interest on the land, you don't own the land? Well, the answer is, first of all, you cannot exchange personal property because that's exactly what a mobile home is. It's not real property unless it's fixed to the land. Just like the lumber and the stucco and the roof and all the pipes and the electricity and everything you have on a piece of property is nothing but personal property until it's what? Fixed, permanently fixed on the land. So if you have a mobile home on land that you own, and it's permanently affixed, then you can do a 1031 exchange out of that. But if you only own a leasehold interest in that land, can you still do it? The answer is you can do it under one of two conditions. Condition number one, that you have a leasehold interest on that land for 30 years or longer, including all the extensions to that lease. So if the lease bears from that point 30 additional years of the lease, including all the extensions that are given on that lease, then you actually can exchange a leasehold interest for real property, and the government will let you do that. The other possibility is if you're selling and you don't have 30 years on that leasehold interest with its extensions, then you could actually exchange, let's say you only have 15 years left, then you can exchange that into another 15-year lease. That will work. So remember, it can't be personal property, it has to be real property, and what makes it real, that it's property and that the mobile home is fixed to the property itself. So if you come across this or it seems confusing, it's confusing to me sometimes, but the bottom line is we'll be happy to explain it to you and look at your individual situations. But yes, you can exchange leasehold interest. Did you know that you can exchange mineral rights? So if somebody's acquiring your mineral rights, as long as that mineral right is considered real property in the state that you're selling in, it is allowable. As long as what you're going to buy, if it's going to be mineral right, and it's considered as real property, so you can exchange it into just land if you want, or a building. But if you want to acquire another mineral right into another state, but it's called personal property, not real property in that particular state, because in some states, oil is not considered as real property. Some states it is. Water rights are not considered as real property in some states. Other states, it is. So you have to make sure and come ask us, and we'll help you and your CPA work through this in the event that you're dealing with mineral rights and easements and things of that nature. And we'll be happy to talk with you about that. Those are still exchangeable. Here's the number one question I get. I speak at 150 plus seminars this year, more than 150. But this is the number one question I get. May I move into the property at some point if I buy a residential property? Remember, you have to buy a like-kind property. Now, I can sell a commercial building and buy a single family, but not for personal use, only for investment or rent. That would be considered as like-kind. The federal government, the IRS, I have to keep my throat wet, thank you, has a real problem with people buying property with the intent to convert it. They don't like that. Why? Because your intent was truly never to hold the property for investment use. It was just simply to get out of the taxes and then wait for the minimum amount of time, and then you would convert it. So in the code, it talks about 2 years. So does that mean after 2 years, I can convert it to a personal residence? The answer is no. The government allows for it if you bought it if you bought the new single family with the intent to not convert it, to hold it for investment. But if something happens, if you look at the bottom, if there's something that happens that's unexpected, unanticipated, or unplanned change in your life, then your CPA can make that decision. Not me, and certainly not you. If you don't have a tax license, or if you're not a tax attorney, you can't give that kind of advice that they can move into the property. You hold it for 2 years and then move in. You can't do that. That's giving tax advice. And if they get caught, they're going to say that you or I gave them that information. And we can't do that. So what allows me, or what might allow a CPA to allow me to convert a property that I've done an exchange into, what kind of circumstance? Well, remember we said unexpected, unanticipated, or unplanned. So one thing that could be unplanned is a health change. I become disabled. I could no longer go upstairs in the property I live in because I've had some major knee surgeries and problems where I just can't do that anymore for the rest of my life. I'll need to move into the one-level rental that I have. That could be a possibility because it was an unexpected, unanticipated, or unplanned change in my life. That's up to the CPA, not me. It's up to the CPA to make that decision. But that could be one of the reasons that they will allow. What about if we have some kind of a big financial crash personally, and I lose a lot of my assets, and I need to move in to one of my properties because I'm going to lose my home? The answer is, well, that could be an unanticipated, unexpected, or unplanned change financially that affects me that I have to move in. The CPA will make that decision, and then if the CPA allows me to, I can then convert it because I didn't buy it with the intent to move in. Or how about a family change? What about an unanticipated divorce? Unanticipated. So if you're having problems and you're getting marriage counseling, or you've already filed for divorce, that's not going to work. But I have a death in the family or an unanticipated divorce, and it's created a lot of hardship. It is possible that the CPA may allow you to in that situation. And by the way, speaking of divorce, I'm getting a lot of calls these days about married couples who are in a divorce. Generally speaking, can they just decide which properties they want to keep and then do a 1031 exchange without the other spouse? The answer is you better be very careful, and we'll need to counsel you with this. And they'll also need to talk with their CPA. Because remember, as long as they're still married, they live in a community property state. That means they both have to be on title. That means that they're only buying a half interest. And what about the rest of the funds? And are you buying enough property? So in fact, I had this very interesting case. In fact, it happened this week. The husband and the wife who are getting a divorce. Apparently they have a very amicable divorce. So they decided that they would record 2 deeds, one on the principal residence and the other one on the rental property. The wife was given a deed by the husband, because they're still married, and gave it to her as her sole and separate property as a married person. The other one, the man, she deeded her half of the rental to him fully as his sole and separate property as a married person. I think that's going to go through without a problem, even though they're still married, because they're in the midst of a divorce and they recorded these quitclaim deeds. So before you start giving out advice on to divorce people on what to do, they should really be talking to both their CPA and their divorce attorneys. Because what happens if somebody changes their mind and they don't want to give them that much, or they're deciding on which properties they want to own and not own? Be careful. Divorce can get you into a lot of trouble if you're trying to work with people and trying to counsel them on who gets what. Be careful. But that's why I mentioned that divorce could be a reason that you may have to move into an exchanged property after 2 years. That is a possibility. But again, it's only the CPAs, it's at their discretion to allow you to or not. Because if they get audited, the CPA has to represent them in the audit, not you, not me, because you and I are not going to do that. But the CPA will have to do it. Why? Because it's a tax decision after the fact. And a tax decision to deed property out, it's a tax decision to convert a exchange property into a personal property. They should be talking to a CPA, not you or me. All right. What about relatives? I work with a number of investors all over the country that sometimes they're going to sell to a relative or they're going to buy from a relative. How does the government feel about that? I'd like to talk with you about this. This is a very important point. First of all, what is a relative, or what the government calls a relative, a related party? Is it your aunt? Is it your uncle? Are they your nieces and nephews, your cousins? Is it your parents or your children? What exactly is a relative? Well, according to the IRS, a relative is a direct line, a direct descendant. So for example, it's called a linear descendant. You follow the lineage. The lineage is this: a grandparent to a grandchild is a relative. It's considered a related party. A grandparent to a great-grandchild is also considered, because it's a straight line relationship. Married people to each other are considered relatives. Your siblings would be considered as relatives. So that means brothers and sisters. That also means parents to children. That's also a straight line. So that's considered a relative. What is not considered a relative is your niece, your nephew, your cousins, your aunt, your uncle. There's still a relationship, but they're not considered a straight line related party. Now, the government says that if you're doing a 1031 tax deferred exchange, you can sell to a related party, but after the sale and the purchase is finished on both sides, on what the exchanger is selling and what they're buying, so they sold to a related party and they bought from a stranger. Now, after the exchange is finished, both parties have to wait for 2 years and hold their properties. The related party that I sold to, and the person, and my new property that I bought it from a stranger. And the two of us have to hold those properties for 2 years minimum, 24 months. If for some reason one of us sells those properties, that the one I sold to my related party relative and the one I bought, if either one of us sell and close escrow before the end of the 2 years, it destroys my 1031 exchange. So how does the government keep up with that? Well, because on the 8824 form that your CPA will file on your tax return under your Schedule E, it asks a question. Did you work with relatives on this? So they can track those property transactions by virtue of the fact that that box was checked. And the CPA has to be careful, because if they misrepresent that information, they are guilty of penalty of perjury, which means they're in big trouble with the IRS and the Franchise Tax Board, and so is your client. So be careful when you sell to a related party, that both parties will eventually, the one you sell to and yourself, will hold those properties for a minimum of 2 years, beginning at the end of the sale of the, I should say, the end of the purchase, after my exchange is over. Number two, can I buy from a related party? So can I buy from my sister or my grandparent or my children? Can I do that, the aunt and niece, and do a 1031 exchange while I'm doing that? The answer is no. The government will not let you do a 1031 exchange if you're purchasing your related party's property, unless, and this is the only exception, unless that other party is also doing a 1031 exchange. If the other party is also doing a 1031 tax-deferred exchange, then we can both do our exchanges and we can buy and sell with each other. That's even though we're related parties. That is not a problem. What they have a problem with, that is the government, is when you sell to a relative, when you sell to somebody and then you buy from a relative, they do not want you to buy from your relatives because that creates what they call a shifting of basis. And they feel that people are trying to get out of that by making these deals with their relatives. So the answer is, you can't do it. Some people ask me, well, what about my brother-in-law or my parents-in-law or my sister-in-law? Are they relatives? The answer is yes. As long as you're married to your spouse, the answer is yes. They will not be relatives if you're involved in a divorce and the divorce is now final. After the divorce is final, they're no longer your relatives because you're no longer married to your ex-spouse. Those are her relatives now, not yours, because the divorce fixed all that, supposedly. But the bottom line is that you remember, you can sell to a relative, but you can't buy from one unless all parties are doing a 1031 tax-deferred exchange. I hope that clarifies the subject, and let's move on to something else. What if I do, remember we said, can you convert the property into a personal residence? Well, in, I think it was, let's see, October this month in 2004, so that was 16 years ago. Congress back then created the 5-year hold. What is the 5-year hold? The 5-year hold says that if you do a 1031 exchange into a property and something unanticipated happens where you have to convert the property into a personal residence, and then you live in it for 2 years and then sell it. So you owned it as a rental for 2 years, you lived in it for 2 years as a personal residence, now you've owned it for 4 years. The government says you can go ahead and sell it, but because you haven't held it for 5 years, you will not get the benefit of the 121 principal residence exclusion, even though you lived in the property for 2 years, even though you've owned the property for longer than 2 years. Why? Because you did a 1031 exchange into that property, and to get any benefit off the 121 principal residence exclusion, you have to hold the property for 5 full years. Still living in only 2, but you have to have title to the new replacement property that you bought in your exchange for no less than 5 years. Well, that got changed a little bit because in October, I don't know what it is about the month of October, but in the month of October in 2008, so that was what, 12 years ago? Congress then, that Congress back then, created something called the Housing and Economic Recovery Act of 2008. And this is what they said. They said that, number one, it would go into effect on January 1st. This allows for a conversion of a non-principal residence into a principal residence. So for example, let's say I did a 1031 exchange into a piece of property. Something happened. I had to move into it. It was legitimate. My CPA said it was okay. And I live in there for at least 2 years, but at least I've had title to it for 5 years. Or I just move into a regular rental that I own. I didn't do an exchange into it. It's just a rental that I've owned for 20 years or whatever. Or I have a vacation home. Remember, vacation homes are not exchangeable. But I convert my vacation home at the beach, as an example, I wish I had one there, into a principal residence. So I retire, we move down to Huntington Beach or wherever, Newport Beach, Balboa. Oh, my mind is just turning with these wonderful places by the water. But what happens is we decide to convert our second home or our rental at the beach and we make it our principal residence, and we live in it for 2 years. And now, guess what happens? I want to sell the property. Can I get the full $500,000 because I'm married, filing a joint return with my wife? We both have title to the property through our trust. Can I take the $500,000 after living in it for 2 years? The answer is not anymore, because the Housing and Economic Recovery Act, if you want to call that a recovery, that went into effect on January 1st, 29, said if you convert a rental or a second home or vacation home that you already have owned into a principal residence, you wait for 2 years to get the 121 principal residence exclusion up to $250,000 as an individual, up to $500,000 as a married couple. Guess what this Housing and Economic Recovery Act did to that? It says that your CPA has to go back to when this went into effect, January 1st, 2009. So he begins counting how many years you own the property that you didn't live in it. It was either a rental or a second home. And then they look at the time that you actually lived in it. Could have been 2 years, could have been 3 years, could have been 5 years, whatever. And then they come up with this formula of, they have to come up with a numerator and a denominator. It really gets confusing. And some CPAs are very confused by this. But here's the bottom line. You don't get the $500,000 anymore. You only get a part of it based on that equation, based on how long you lived in it versus how long it was a non-principal residence beginning on January 1st, 2009. They can't get the $500,000, so they go to sell the property, but they never check with their CPA. And then they find out they're only entitled to $100,000 of the $500,000, or maybe $150,000, or maybe $200,000. But the rest of it, they're going to pay capital gains taxes. That is a real problem. And that went into effect January 1st, 2009. So before, when you take a listing, let's say on somebody's principal residence, and they bring up the topic of taxes, you say, oh yeah, you know, you're married, you both own the property, you'll get $500,000. How do you know it wasn't a conversion? How do you know that somebody didn't just gift it to them or some other thing? So be careful, be careful, be careful. If it was a conversion, they're not going to get the whole 500,000 anymore, or the 250. And it is very difficult equation to try to figure out how it works. Next, can I combine the 1031 and the personal residence exclusion on the sale of the property that I'm selling? Will the government let me do that? Well, back in February 14th, which happens to be Valentine's Day, which will be here before you know it, in 2005, the government gave us what I call a love gift because it was Valentine's Day. Prior to this date, they said if you had a personal residence that, for example, you owned it for 20 years, 30 years, you bought it, you raised the children, and now it's really a big house and the two of you are older and you don't need such a big house anymore and you decide to sell it. Well, the government, and let's say you decided to convert it to a rental and then you rent it for 2 years. Back then, before 2005, if you sold it, the government says you can only have either the 1031 exchange because it's been rented for 2 years, or because it's been rented for 2 years, but you lived in it 2 out of the last 5 years, it was your personal residence. So they'll give you up to $500,000, but you couldn't have both, either the 1031 exchange or the 121 principal residence exclusion. On February 14th, 2005, guess what love gift the IRS gave us? They now let us do both, which means they will allow me to take my personal residence of so many years and then convert it to a rental, rent it for 2 years, for 24 months. And after that 24th month, I could list the property sell it and close escrow before the end of that 3rd year that I don't live in there anymore, the government will let me take up to the $500,000 of capital gains exclusion if I'm married filing a joint return like this, or up to $250,000 if I was single. And they'll let me do a 1031 exchange with the balance. They'll actually let me do both. These are great for properties that are owned in high areas like Chapman Woods, places like La Cañada, San Marino, and other types of other properties, Arcadia, where people bought them a long time ago, and now they have a plan. They can convert it, rent it for 2 years, and then sell it. They can take up to the $500,000 exclusion, put that in their pocket, and do a 1031 exchange into some other kind of rental afterwards, and it becomes a real win for them. This was unbelievable when they passed this. It's an incredible tax benefit. How long will it be around? I don't know, because everything you look at on propositions and elimination of the 1031 exchange and tax, now they're gonna even do a wealth tax in California. It's on the ballot, or they've been discussing that, I should say, up at Sacramento. I'll be talking about that tomorrow night. There's just, the government's going tax, they're going after you if you have anything. And the bottom line is they want the money. And that's just the way it is. So be careful. There's also something called the California Clawback. I'm getting this question quite a bit lately. The California Clawback says that if you sell a property in California and do a 1031 exchange into out-of-state property, first of all, can you do that? The answer is yes. You can definitely sell and leave California and do a 1031 exchange where? In any state in the United States. Hawaii, Alaska, Texas, Arizona, Utah, Idaho, Nevada, Florida. I mean, I'm not going to name all the states, but I think you get my drift. You can buy anywhere in the country and do a 1031 exchange. But you see, California has a clawback provision. What does that mean, clawback? Well, if you think about it, if you were looking at one of our flags, the flag for California has a picture of the bear on there. The bear has a claw. That basically means that since California must allow you to do the 1031 exchange, defer the California state tax, which is averaging now between 9 and 13.3%. And by the way, you'll find out tomorrow that they're ready to raise it by up to 3 points. So if you're in a 9% bracket, it can go as high as 12. If you're in the 12, it'll go to 15. If you're in the 13, it'll go to 16. The way it is, and it's going to become retroactive all the way back to January 1st of this year. That's income tax. That's money that you make. So be careful. That's in the works right now, and I'll talk more about that tomorrow. But the bottom line is, once you exchange outside of California, the government says that they can't have the IRS says you can't have the money unless you sell the property and not do another 1031 exchange. So it becomes a taxable sale. So at that point, California can claw back the amount of tax you owed them back from the time that you sold and exchanged out of California. Your CPA has to file one form every year. It's the one in red, about the middle of your page. It's called the 3840 form. It's not that difficult of a form, but it is mandatory that you file it every year at tax time. The state goes on to say that if you don't file that, even if you haven't sold the property, they will consider the property as sold, and they will claw back and take their tax money from you. They will chase you for 10 years. So be careful. If you're going to exchange out of California, just file the form every year at tax time. Even if you don't live in California anymore, you have to file that form 3840. So, because the state wants your money. That's just the way it works. A lot of folks have been asking me, what's up with reverse exchanges? So many people are doing these now. What is a reverse exchange? How does it work? And why does it cost so much to pay an accommodator to do a reverse exchange? Well, as you know, there's not a lot of inventory out there, except in Arcadia. That just seems to have a lot of inventory for some reason. But for most areas here in Los Angeles and in the state, and really it isn't just our state, but it's many states, it's hard to find replacement property because property is in demand. A reverse exchange allows you to close a purchase through the accommodator and then sell up to 180 days later. This is what happens in a reverse exchange. Number one, I find a property that I love and I gotta have it because I think it's gonna be a really good property for my portfolio. So a reverse exchange allows me to close escrow before somebody else, or acquire the property, get into a purchase transaction, and then close it so no one else will get the property, only me. Number two, if that's not the case and I'm afraid to sell because I only have 45 days after my sale closes to identify replacement property, what if I don't find that property in 45 days? Which you probably won't because of the amount of inventory that's out there. Or you get into a bidding war with other buyers. Well, the bottom line is the government will let you do a reverse exchange, not sell, buy first, and then close the sale up to 180 days later. That's the second situation. The third possible situation to utilize a reverse exchange in is when you have two escrows going on. You have the sale of what you're selling in a 1031 exchange, and you have what you're buying in escrow as well in a 1031 exchange. And you've really done a good job. You worked very hard to make this happen. The sale will close in 2 weeks. The purchase will close in 3 weeks. You're only going to have a gap of 1 week in between properties. You really worked hard and you did a good job, except for one problem. The buyer of what you're selling falls out of escrow. You either can't get a loan commitment, or they get cold feet, they have buyer's remorse, or they find something else and they want to leave your property. But the bottom line is, you're supposed to close in 2 weeks and you're on the sale, and you're supposed to close in 3 weeks on your purchase. What are you going to do? Because you want that purchase. The answer is a reverse exchange. The reverse exchange will allow the accommodator to help you acquire that property first and then close the sale up to 180 days later. So here's the big question. How does this work? Well, first thing, if you look at red on the bottom, we have to do two things. Two things have to happen. Number one, the accommodator has to set up a holding corporation. The IRS calls it an EAT. EAT stands for Exchange Accommodation Title Holder. So in a normal exchange, we hold your funds, right? You sell and then you buy, we hold your funds in between escrow. In a reverse exchange, the IRS tells us that the accommodator has to hold one of your properties, either the one you're selling or the one you're buying. And we can only hold either one of those properties for a maximum of 180 days, which means the sale must be closed before the end of that 180 days. So we could either take title to the property you're selling the day before you close your new purchase. So if tomorrow, October 14th, you're closing your purchase and you're doing a reverse exchange, we will take title in this example to the property you're selling, and that's what will start the 180 days, the day that we take title to the property you're selling. But if you're going in all cash on the purchase, you're not going to need a lender and you have enough cash to cover it. Then we will take title the day of closing to the property you're buying. Remember, even though we have title to either the one you're selling or we have title to the one you're buying, you still have two properties, which means you'll be collecting rent off both properties. So it's not like you're going to lose income. And the second thing is that you'll have to manage the property, you being the taxpayer who's doing the exchange. They'll have to take care of both properties. They'll have to take care of the incoming rent, the tenants, would they have needs, any taxes, insurance, or any other repairs or whatever. It all will be done by the client. We just have to hold title to the property because the IRS, remember, will not allow you to hold two properties at the same time. Remember we said before, you can't exchange in the property you already own when we were talking about keeping funds to do improvements after we acquire. It's sort of on the same kind of thinking. The government says that you can't just buy a new property, take title to it, and then later on sell within 180 days and close escrow within 180 days on something you already own. You can't exchange into something you already own. And that's what the federal government is saying. So that's why they force us, the accommodator, to hold title to either the one they're selling or the one they're buying if they're going in on cash on the deal. So that's how a reverse exchange works. It's a perfect exchange for people who have found something and they have to have it, and they have enough cash or cash and loan to acquire it because they don't want to lose the deal. All they have to do is in a market where everything seems to be selling like crazy to sell a property and close that sale within 180 days. Government will let you do that. It's a perfect fix in a market like this. You don't see too many reverse exchanges in a slower market. You tend to see them more in busier markets where there's not a lot of inventory and there's a lot of demand, like today. I have information I can send you on the reverse exchange that'll go into some details what I've just talked about. The government will also let us do something called a hybrid exchange. What is a hybrid exchange? The hybrid exchange, well, if you think of a hybrid car, I don't know how many of you own like a Prius or something that runs on gas and electric. Well, the government says that, for give an example, you can combine two exchanges, a reverse and a delayed exchange under one umbrella called a hybrid, and I'll explain how that works. So let's say I'm selling two properties, property number one and property number two. I'd like to sell both of them. In fact, I got a call on this just yesterday, and buy property number three. So I'm selling one, I'm selling number two, but I'm buying property number three. I'm not going to sell both of these at the same time to the same buyer. They're separate. That's just not going to happen. I mean, it's possible, but it's not likely. So let's say property number one happens to close escrow before property number two. That's what begins the 180 days to close the new purchase, which is property number three. That also means if I want number two under a delayed exchange to go in with property one to acquire property number three, I would have to close a sale on number two before I close my new purchase, property number three. Are you with me? So this is how it works. What happens if I can't close property number two in time? I could only close the sale, number one, and the purchase, number three. Number two, I can't close in time. That's when the government will allow us to do the hybrid exchange. I will do a delayed exchange on the sale of property number one into the purchase of property number three, partially. The other part of number three that I'm going to set up is a reverse exchange for a part of number three for the sale of property number two. Remember, we just said a reverse exchange is when you acquire first and then close the sale up to 180 days. So property number one goes into property number three as a delayed exchange, and then we build the reverse exchange portion of property number two into property number three, but on a reverse mode, which means I have up to 180 days to close the sale of property number 2. What that basically allows us, like a hybrid car that runs on gas and electricity, a hybrid exchange runs on a delayed exchange, number 1, the purchase of number 3, and number 2 in a reverse exchange into the purchase of number 3. And the government approved that. And now they allow us to do it. So the hybrid exchange is great if you're selling multiple properties to buy one, or you're selling one to acquire multiple properties, and the government will let you do it either way. And that's a good thing. Remember I mentioned to you that earlier that you could not do you can't build improvements on property you already own. You can only do it on a build-to-suit exchange. Well, this is it. A build-to-suit exchange allows the client to not just buy land or improve land, but they allow for the improvements of the land, but not while they own the property. And I want to explain how that works. What happens is they go to sell a piece of property, but they're also in escrow on an acquisition. They're selling for $1 million. They're buying for $600,000. What we do is when the $1 million sale closes, we're going to take the funds and hold those funds and buy the $600,000 new purchase. But we do not give the title to the buyer or the seller. Which is the guy who's doing this exchange. The taxpayer will allow us to set up a holding corporation like the EAT we just saw under the reverse exchange. Same concept. And we will take title, we, Exchange Resources, will take title to the new purchase at $600,000. With the remaining cash that we're holding, because remember, we have to use some of that cash to acquire the $600,000 property, we will write checks and wire money to the contractor. The contractor will build based on your approved plans that you've got permits on. You have to have all this done beforehand. You can't wait to do this afterwards because the government says under any kind of delayed exchange, you have to take title to your property, which we are holding for you, within 180 days. So that means you already had to have had plans. You had to have already had permits. You already had to have a contractor who's ready to go as soon as we close escrow on this acquisition. And with the remaining balance of the 180 days, they build the improvement and we spend all the cash. So when we give you your new property that you bought for $600,000, plus the remaining $400,000 of cash that built whatever improvements that you want, now we can give you the replacement property with improvements and with the price that we paid for it as a full 1031 exchange. You don't necessarily have to finish all the building, but you do have to spend all the cash. Because if at the end of the exchange, when you take title to your property, if there's unused cash, then you'll have to pay taxes on that. And if you have to replace mortgage, you can get a construction loan that will also fund at the time of the day that we deed the property to you. So there's a lot of moving parts. It's very expensive to do this in terms of our fee, in terms of what you're going to have to go through to make this work, because you have to have a lot of planning. But is it doable? It is, but you just have to plan it out. Okay, there's a lot more information we have on that. If you'd like me to send it to you, I'm happy to give that to you. Here's another problem we're having these days. Buyers are asking sellers to carry back again. We're beginning to see more and more of this. So the question is, if you're doing a 1031 exchange, could the seller who's doing the exchange carry back paper financing for the buyer? The answer is no, because that money on the financing that they're collecting, you would negotiate like an interest rate and terms, so amount and terms of that loan. So what happens is, let's say you get a loan for, let's say, 5 years, principal and interest, just to make it simple. Each month for the next 5 years, you will be getting payment of the loan carryback. That is taxable. Not the whole exchange, just the portion that you carried back. It's usually not in a seller's best interest when they have a buyer who wants them to carry back and the seller is doing the 1031 tax deferred exchange. So what happens is there is a way around this, and it's called a seller carryback exchange. And basically what happens is this, is that anything the seller carries back, the seller must have in the bank. When we set up the exchange and the seller and the buyer agree to the terms of the carryback, we, the accommodator, become what they call the beneficiary of the note and deed of trust. But remember I said the seller has to have money in the bank? They can buy that note from us the day after escrow closes. And then they will wire their money to the bank that we're holding for them, additional cash for the note and deed of trust. So if it was a $200,000 carryback, they will wire to us $200,000, and we will now assign the note of the carryback to them. You say, why would you want to go through all that? Well, the reason why is because you see the carryback is really done with the seller's private money, not with the proceeds of the exchange. See, all the proceeds of the sale has to go into the acquisition. If there's any carryback, you're going to get paid in installments. But if you get paid in installments on money that came out of your bank and not out of your sale, the government will allow that. So remember, it is possible to do a seller carryback with a 1031 exchange, but if you don't have money in the bank or somebody who wants to buy that note that we can assign that to, then it just completely screws up the exchange for the amount of the carryback, and your client will have to pay taxes on the carryback. All right. I'm going to pass. Well, I'll talk about it real quick. How safe is my money with an accommodator? We've all read the horror stories in the newspapers. We've all heard on the radio and through the news how some accommodators were messing around. They were utilizing the funds that they were holding for other reasons other than just holding them for the clients. So some people say, what should I look for in an accommodator? So as an exchange person, I know a little bit about that. So let me tell you what I think is best. Number one, make sure your accommodator never commingle the funds. Make sure your accommodator sets up individual client trust accounts for every single 1031 exchange. Never work with an accommodator who commingles funds. Number two, make sure that every client gets a single trust account. That's still number one, single trust account. You know what that means? It's not a corporate asset of the accommodator. And that's what number two is. You do not want it to be a corporate asset of the accommodator. Why? Because we've seen accommodators get loosey-goosey with monies that they're holding for their clients and utilize it temporary for other reasons. What happens if something goes wrong and that accommodator goes bankrupt? Well, if those funds are considered corporate funds, it's not in a client trust account, and it's commingled, the bankruptcy court takes all the assets of the accommodator, which is your client's money, and they pay their debt based on that. Your client is hung out to dry. Not only do they lose their money, but they have to pay taxes on their sale because there's not enough money to cover it. So make sure that it's always a single trust account, never commingled, and number three, which is really number two on the list, it is not that account is not a corporate asset of the accommodator. We call it QI. QI stands for qualified intermediary. That's the legal name for an accommodator as far as the IRS is concerned. Number three, make sure that they cannot and will not move any money out of that account without a signed authorization by the client. The client has to authorize it. It's so important that that happens. We compare signatures, or we call them back on their cell phones, because we're going to ask that you give us a contact number for them just to make sure that they sent us. We just want to say, how much was it? What bank is it coming out of? We want to make sure it's really the client who's requesting the money to leave the account. It's so important to do this. It takes extra work and extra time, but it's worth every penny to protect those funds while they're in the accommodator's hands. Also, make sure they have bonding, errors and omissions insurance, and for crying out loud, internal legal counsel. Not attorneys who are escrow attorneys or title insurance attorneys, but they're attorneys who specialize in 1031 tax-deferred exchanges. That is so important. A lot of people say, well, if I'm doing a 1031 exchange, what happens if my exchange fails and I want my money? Could I get my money back? The answer is here, absolutely. It's not our money to hold, but the government regulates what timing you can get your money back in. You can only get your money back in a failed exchange, or if you choose not to do an exchange, in only 2 different times. On day 46, right after the 45-day identification period, if nothing has been identified, or they revoked all their identifications before the end of the 45th day. Because as you know, you can change your identification several times before the end of day 45. But if you want to not be in the exchange anymore, you can take everything off your list, and the government will let you do that. It's called revoking. So you're basically saying, I'm going to wipe my list clean on day 45, or day 44, or whenever, day 43. I don't want anything on my list. I want my money back on day 46. The government will allow it. How about if I leave the properties on and then I find out I really don't want them, or they're not available anymore? I can't change the identification anymore because it's beyond the 45 days. The government said, sorry, you cannot have your funds back because you have identified properties still in your identification. Therefore, you will have to wait to the end of the 180 days, specifically day 181, to get your money back from the accommodator. These are not my rules. This is the rules of the IRS. People get very angry when an accommodator is holding their money against their will. But it isn't the accommodator's fault. It's the IRS's rules that we have to adhere to. So, my goodness, if you don't think you're going to go through with it, cut it off on day 45 and take everything off your list so you can get your money back on day 46. Let me tell you a little story what happened to me just about a month ago. I had a client who had 3 properties on their list. One property they didn't really like a lot. The other one was an okay property. The third one was the perfect property for them. They lost property, the perfect property, because it went into escrow with another buyer. They said, oh, should we enter our exchange? We don't know what to do. And I said, you may want to think about waiting and see what happens. And see if you can negotiate on any of the other properties that are on your list and see if you can get them. Guess what happened while they were negotiating on the other 2 properties? The first one that they really liked a lot fell out of escrow and it became available again. They jumped on it. They bought that property and they closed it within the remaining balance of the 180 days. That does happen. All the time? No. Some of the time? Yes. I've seen it more than once. So it can happen. Just remember, there's only limits of time where the federal government will allow you to get your funds back. The next question I get quite a bit on is, what is a 1033 exchange? Well, my question is, have you ever heard of eminent domain, hostile takeover, or condemnation? That's exactly what a 1033 is. The government will let you know whether it's the school district that's taken over your property, your rental, or maybe it's the state, or the county, or the city, or even the federal government. If they need to widen LAX and you have a property right off the runway and they want to take your property eminent domain, you can do that under a 1033 exchange. What's the difference? Well, there's a big difference between them. Number one, there's no 45-day identification in a 1033 as there is in a 1031 exchange. So that you don't have to identify at all. So that's pretty good. Second is the acquisition time is not 180 days. It's either 2 years or it's 3 years, and they will advise you as to whether it's 2 or 3. That's also pretty good too. Number 3, no accommodator needed, and we don't hold your money. The client gets to hold their own funds. And if the client puts it in an individual account and does not commingle that money with anything else that they own, they don't have to pay any taxes on the interest that they earn on the money during that 2 or 3 year period. And that's pretty good too. The downside is the definition of like kind is more narrow. It's different. But it's very vague, and it doesn't give a lot of clarity in the code. So if you're involved in a 1033 exchange with eminent domain, hostile takeover, or condemnation, what'll happen is you can't go from an apartment building to vacant land, like vacant commercial land. They won't let you do that. They will in a 1031 exchange, but they won't in a 1033 exchange. So you'll have to talk to your CPA as to what is more of a definition of like kind, of which they probably won't know either. And they're going to have to do the research and find out what we found out. It's very vague. So the bottom line is you don't need me, which is sad, but it's good for your client, I guess, right? One more thing. I have talked to LA County, and please don't misunderstand what I'm going to say. I've talked to the Los Angeles County tax assessor. And they said if the property's in LA County and it's taken by eminent domain and hostile takeover or condemnation, in many cases, they will allow you to take your property tax basis with you as well as your regular basis of your capital gain. So in other words, they'll let you take the basis of property taxes in a 1033 to another property. You may want to check with LA County to find out if your particular property that your client is selling through a 1033 exchange qualifies. Call Carol Kwan at LA County. She's the assistant to Jeffrey Prang, who is the assessor for LA County. So you may want to check that out. We already talked about this a little bit, so I'm going to pass it. Remember, well, you know what? We're just about out of time here. We're down to like 5 or 6 minutes. And I think there may be a few questions in there. So ladies, are you still with me? And do you have a number of questions you'd like to ask that I can answer? Because I know we're down to 5 minutes.
Yeah, I think there are a few questions.
Okay, I was told that you were going to ask me those questions.
Yes, I am.
Okay.
Hold on a second.
Yeah, take your time, Jeannie.
Okay, first question. If the property is held in an LLC, is the replacement property for 1031 exchange to be held under the same LLC? Can it be held under the sole member of the LLC instead?
If it's a disregarded entity, yes. If it's a non-disregarded entity, no. Because remember, if it's an LLC, which tax identification number is it? Is it the seller's personal identification number, their social security number? If it is, they can take title to it by themselves, not in the LLC. So remember, they need to go back to their CPA to verify if it's a disregarded entity or not. That is so important for a single person and for a married couple, because only those two people, a single person or a married couple in a community property state, can utilize the disregarded benefits. But don't forget, a married couple or a single person, if they do not have a disregarded entity, then guess what? They can't put it in their name because the property has its own tax ID number and it's not them. It's not their social security number. So be careful, be careful, be careful.
Second question, if I sell a residential vacant land, what type of investment property can I exchange to that's considered like kind?
That's a very, very good question. And here's the answer. Any kind of investment real estate. I can buy a hotel, but not the business or the equipment of the business or the goodwill of the business, but I can buy the building. If I'm selling residential land, I can buy a storage facility. I can buy a warehouse. I can buy vacant commercial land. I can buy a gas station, but not the business, not the equipment, but just the property itself. I can buy a car wash, not the I can buy the property, but not the business or the equipment. You can buy virtually any kind of investment real estate. Remember, what is not exchangeable is if you go into a property that you're going to live in or utilize it as your second home or your vacation home. That's personal use. That is not allowed. And remember, we talked about conversion. If you can convert it into a principal residence, that they're going to have to talk to their CPA about. But remember, we talked about that. So it could be any kind of rental or business use or investment property. That's the answer to that question.
Next one. I think you have already answered this, but I'm going to read it anyway. So can I convert a primary residence to a rental property and then do a 1031 exchange?
After 2 years, yes, after 2 years. It must be rented for 2 years. Same is true with a second home, by the way. You can definitely sell it and do you can convert it from a personal use, your second home or vacation home, into a rental and wait for 2 years. Now the government says you are protected under what they call the safe harbor of the code. So you can do a 1031 exchange into any kind of investment property.
So is there any requirement on the tenant? Can it be relatives?
Oh, that's a good question. I'm glad you brought that up. The answer is yes, if it is a relative of any kind, including cousin now, they have to pay you 85% or more of fair market rent. If you simply rent it out for half price or whatever, the government's going to say it was never a rental. It was a second home and it stayed as a second home because you didn't charge fair market rent to your relative. They will take away the investment status of that property, make it a second home, and second homes are non-exchangeable. That is so important, and I'm glad you asked that question.
Next question. If I live in a house for 20 years, then converted in a rental for 5 years, can I still combine the sale of this property with both the 1031 and 121?
Remember, you had to have lived in it 2 out of the last 5 years. In this case, you would not have. You had to have lived in it for at least 2 years, going back 5 years. If you've lived in it for 2 years over the last 5, then the answer is yes, because here are the 2 years that you lived in it, and then you rented for 2 years. So that's 4 years. So now you've got to close escrow between year 4 and year 5. That's how you could take a personal residence, rent it out for 2 years, then what? So you lived in it for 2 years, you rented it out for 2 years, and then in that last year between year 4 and year 5, you do the 1031 tax deferred exchange and take the 121 because you did live in it 2 out of 5.
Next one. If I occupy a warehouse owned by my LLC or a corporation, can I sell it and do a 1031 exchange?
Yes, because it was your warehouse and you used it for your business. As long as you use it for your business, that's not a problem. I mean, I wouldn't store my RV there or any of those type of, or your boat or whatever. But as long as this warehouse is being used for any kind of business, for your business, or you rent it out to somebody who's using it, either way will work. You can do a 1031 exchange.
Okay, I think this is the last question. Please kindly repeat the disregard LLC benefits.
The disregarded LLC benefits is only for an individual or a married couple in a community property state, which means the tax ID number of the LLC can be their social security number. And if it's their social security number, that means as long as they're buying under their social security number, they could actually buy it in their name. And the government will let them do that. And that could help out with financing and in terms of lower cost financing. I've talked to lenders about this quite a bit. And some lenders are very familiar with it. Some have absolutely no clue. So be careful when you're working with someone that they understand the difference between what they call a disregarded entity versus a non-disregarded. Remember, disregarded means it's a single person or it's a married couple that has the tax ID number of the vesting as their social security number. So important. And then when they buy under the same social security number under either the LLC or their individual name. Because this, again, it's the social security number that the government is looking at. Is vesting important? Yes, it's very important. But the tax ID number is really the main event as far as the IRS and the Franchise Tax Board is concerned.
Okay, that was the last question.
I can't believe we've spent an hour and a half. I've got so many more things I can talk about, from purchase expenses, what's allowed, what's not allowed, selling expenses, what's allowed, what's not allowed, what the government expects from us in terms of debt replacement, cash replacement. But we did learn a lot today. At least I hope we did. And I hope this was worth your time. I'm so honored that the West San Gabriel Valley Association of Realtors would ask me to come back again so many times. If you have any questions, don't hesitate to call me. I will leave my contact information right on the screen for just a second. If I can get to it, there it is. Phil Atwan, you can at gmail.com, or that's my phone number. If you have any questions, there's no obligation. It's my privilege and honor to answer your questions for you. But thank you for having me here today.
Thank you, Phil.
Amy, thank you to you as well.
Thank you.
Thank you so much. And thank you, Jenny. Thank you, Phil. Jenny, you're a wonderful moderator for this section. And Phil, you're so informative and wonderful presentation for us for Advanced 1031 Exchange. We really learned a lot from you. Thank you. On behalf of West San Gabriel Valley Realtor Education Committee, we want to thank you again for your wonderful presentation to us. Before the meeting adjourned, I want to remind all of you to check in and register the next Tuesday's class. Mark Wu, Allstate Insurance, will tell us contrasting the difference between the home and condo insurance coverage. And next Friday, we have very great national speaker, Mr. Mark Given, give us a selling in a social distance world. He is a national speaker and coach, and we prepare for you another October 27th, Tuesday, another speaker, Shelley Cofini, give us a very great speech for short sale and forbearance. I believe you want to learn the section too. And for October 28th, Wednesday, 11 o'clock, we bring you another commercial section. Vincent Zhou from Signature Property will tell us how to price a development project and assess a land value. That's very important for you want to learn something new. And for October 30th, Friday, 10 o'clock to 12, we will give you a broker symposium, and we have 3 great speakers coming. Please check in all these 5 coming great classes to learn together. Be safe, happy, and healthy. And I want to thank you again, Phil, and thank you again, Jenny, for this wonderful 1.5 hours to us. Thank you again, and meeting is now adjourned. Everybody come back next Tuesday for our class. Thank you so much. Bye-bye.
Bye-bye, everybody.